Welcome back, everyone, to TradePhantoms Foundations of Trading. I'm Mr. Black, and we are going to be going into Lesson 2, which covers some essential trading terminology that every trader should know. So let's get started with some basic stuff. Bull markets versus bear markets. A bull market or a bullish market is a market in which the prices are rising or are expected to rise. So when the bulls take control of the market movement is going up, and the market is defined by establishing higher highs and higher lows. It is an uptrend, it is directionally moving upwards. A bear market or bearish market is a condition in which the prices are dropping or are expected to drop in the market. So when the bears take control of the market is going down and you are achieving lower highs and lower lows. Where these concepts are supposed to come from, the theory behind where these terms were derived is the way in which these animals attack their opponents. So when bulls attack, this is just a little trivia for you guys to know, they thrust their horns up in the air, and that's why they say a bullish market is one that is going up. Bears, on the other hand, they stand on their hind legs and they tend to drop down on their opponents, and that's why a bearish market is one that is going down. If you are not establishing directional movement, if you are neither achieving higher highs and higher lows or lower highs and lower lows, then you are what is considered to be a consolidating or sideways moving market. So a consolidating market is one that is non-directional. It is neither establishing an uptrend or a downtrend. It is simply moving along, right? So it can be look like this in figure 1, where you have more of a range bound consolidating market, not achieving higher highs, higher lows. Or you can have wedges or pennants, in which, like in figure 2, in which price is simply converging towards a central point and not really achieving higher highs or higher lows. So a consolidating market is defined by establishing equal or lower highs and equal or higher lows. That's what you're doing when you're doing a consolidating market. So non-directional movement. Going long and going short. A long position is one in which the investor expects the security or asset to increase in value. So this would be considered a buy position. So buy low, sell high. If you buy something at $100, it goes up to $200 in value, and then you sell. You would have taken a long position because you're expecting the product asset to increase in value. So you're making money as the market goes up. You're going long. A short position is one in which the investor expects the decrease in value. And that would be a sell position. So if you think the asset is going to go down in value, then you would actually short the position and you would sell first, and then you would buy later to cover. Now, this often confuses people, and we will talk about this more in depth, but I always try and keep it very simple for everyone. All we're doing in both cases is performing two actions. If we're going long, we are buying first and then we're selling later. And if we're going short, we sell first and then we buy later. It's still buying and selling, just in reverse order. So in both cases, you're still buying low and selling high. You're just doing it in reverse order if you're shorting. You sell high first and then you buy later to cover. But we'll talk about that more in depth when we talk about shorting in one of the lessons here. A demand zone, especially an institutional order flow demand zone, is an area in which buyers have historically purchased an asset or security heavily, causing major price action upwards. And these zones can present future opportunities to buy or go long. So if I have an area where a major financial institution bought heavily, because banks place such large orders, they create major imbalances in order flow, causing price to move. And these can provide us with potential future opportunities to take advantage of these levels should price retrace back to them. So it is an area of historically high purchasing. A supply zone, especially an institutional order flow supply zone, is an area in which sellers have historically sold an asset or security heavily, causing major price action downwards. So these zones may also present us with future trade opportunities should price come back to those levels, because banks place such large orders that typically they aren't able to fill their full order at once. And we'll talk about this more in depth, but I always try and encourage people to understand the distinction between supply and demand and support and resistance, which we're going to talk about next, because sometimes people confuse these two concepts since they will sometimes coincide in terms of location. So let's understand the distinction between the two. So supply and demand are areas of heavy buying, supply are areas of heavy selling. Support or resistance are simply tops and bottoms, usually with at least one or more retests of a level. So a support level refers to a price that an asset has difficulty falling below over a period of time. In other words, every time we come back down to this price, it has a hard time moving through that level. A resistance is a price that an asset has difficulty going above over a period of time. So every time we come back up to that line, price has difficulty breaking through that level. So you can see right here, resistance and support, the tops and the bottoms here is what we're looking at on this chart. A pivot point represents an area in which the price of an asset reached either a top or a bottom and then changed direction in reverse direction. So here you can see how we can have areas of supply and demand coincide with support and resistance, but you can also see how resistance at the very top of that wick would not be where we would be entering for an area of supply, whereas the support would be right in the middle of a demand zone, which we will talk about more in depth when we talk about zone structure in further lessons. Some other essential trading terminology. When you place orders in the market, there are two types of orders you can place. You can place either market orders or you can place limit orders. A market order is about speed of execution. It's get me in as quickly as possible. I will pay whatever the current market price is. So think of the same way if you go to a restaurant and you want to buy a lobster, what is the price of a lobster? Market price, whatever the price is that day. Limit orders are specific entries and exits. So in a limit order, the investor is only willing to buy or sell a security or asset at a specific price point or better. They are not willing to pay any price. They have specific price points where they want to enter or exit. This is an interesting thing to be aware of because most retail traders, when they place orders in the market, they place market orders. Retail traders tend to be very reactionary to price action. So when they see price moving, they go, oh my gosh, get me in as quickly as possible. I don't want to miss this opportunity, right? Banks, hedge funds, financial institutions, and professional traders almost exclusively place limit orders. So they take a very different approach to it. They are not willing to pay any price. They have specific price points where they want to buy. They have specific price points where they want to sell, and they wait for price to come to those levels. So it's a very different perspective in terms of how professionals trade versus how most retail traders trade. One is very reactionary. The other one requires more patience, and you're actually waiting for price to come to you rather than chasing the price movement after it's already occurring. Day traders versus swing traders. So a day trader is a trader that will place intraday short-term trades and will close out all positions before the end of the day. So they are not holding positions outside of market hours or overnight. That is what a day trader is. So if you open and close your trades within the same trading day, that is considered to be a day trade. Swing traders will hold positions overnight and sometimes over longer periods of time, a few days, few weeks, few months, right? So a swing trader is any trader that is holding a position overnight. That is what swing trading is. Fundamental analysis. So you may have heard this term, fundamental analysis. FA, or fundamental analysis, is a method of assessing the overall health of a company, industry, sector by looking at both macroeconomic and microeconomic factors. So think of like news, earnings reports, major industry and economic news, things of that nature. These are all forms of fundamental analysis. So fundamental analysts will evaluate industry and economic news such as GDP, interest rates, retail sales, etc., and of course earnings reports. They will also consider these microeconomic factors such as we just said, companies' earnings, PE ratios, effectiveness of its management, etc., etc. And so you're trying to determine the health of an economy, industry, sector based off of this information that you're collecting. Now, fundamentals can have a pretty significant effect on the market, right? If there's something very significant that occurs news-wise that may affect a company or industry, that can create a situation where a lot of people react to that news and either start buying up or start selling an asset. But it is important to understand that this should only be used as a confirmation, and it's very difficult to trade fundamentals as a standalone form of analysis because on their own, they tend to be very inconsistent. So definitely something everyone should be aware of. Everyone should always be aware of what's happening in the world and the economic calendar if you're going to be trading in the financial markets. But we use this more as a confirmation, not as a standalone decision-making factor, because it's very hard to establish consistency when just looking at fundamentals. Technical analysis is one in which, or TA as it's called for short, is one in which investors are trying to identify trade opportunities by studying trends and patterns on the price charts. So think about all those things you learn over at online stuff like Support, resistance, moving averages, Bollinger Bands, Elliott Waves, stochastics, RSI, Fibonacci retracements, volume, MACDs, VWAP, candlestick patterns, Ichimoku clouds, momentum, all that sort of stuff, right? All of that is considered to be traditional technical analysis. So you're going to be studying statistical data like price action, volume, etc. And most traders will often use indicators and oscillators to help them make investment decisions. Now, traditional TA can be useful again as a confirmation. As a standalone form of analysis, it tends to be very inconsistent. So it is important to, of course, understand how to use these tools correctly, more as a confirmation and not as a standalone decision-making factor, which we will cover more in depth as we go into further lessons. Position size and position sizing. So a position size refers to the amount of capital in a trade or investment. And the amount you should position size into trade, or what is recommended at least in terms of the industry, is going to be very dependent on how much capital you have. The sizing in trading and investing refers to the process of determining the appropriate size of a trade or investment, considering factors like your overall capital, your risk tolerance, how much you're comfortable risking the market, and of course, potential gains. So this is something that will be individual to the person, but there are certain factors that go into place in terms of making sure that you are not over positioning, over leveraging, and overexposing yourself in the market. So most professional traders will never exceed more than 2% value at risk, which means in terms of maximum exposure on a single trade, usually they will not leave themselves exposed more than 2% of their overall account size on any one given trade. Therefore, not putting all your eggs in one basket, as the expression goes. We will talk about this more in depth when we talk about risk management in further lessons. A stock is a share of ownership in a company. So when a company goes public, they issue number of shares in terms of representation of the company. So when you're trading in the stock market, you're basically trading little pieces of the company. That's what you're doing when you buy and sell shares. A bond is a loan that you make to a company or government with the promise that they will repay you with interest over a certain period of time. An index is a selection of stocks that is used to measure the performance of a particular market. So examples of indices would be the S&P 500 or the Nasdaq. The S&P 500 being 500 of what Standard & Poor's considers to be a good representation of the market. Mutual funds and exchange traded funds. Now, a lot of you have probably heard of mutual funds because if you have a 401k, IRA, TSP, 403b, any of these retirement vehicles, probably your company has implemented some of these mutual funds inside of that portfolio. So a mutual fund is a type of investment vehicle which consists of a portfolio of stocks, bonds, and other securities. So essentially you have some analysts going looking and they're putting all these different stocks, bonds, other securities all into one big basket. And then what you get when you get a mutual fund is you are buying a cross-section slice of that whole basket. You're getting a little piece of each of these things that they put into the basket. That's what a mutual fund is. Now, in a lot of cases, these aren't the best for the customer because they tend to have very high fees associated with them that benefit more the investment firms than the actual investor themselves, if you're a retail trader. Exchange traded funds are very similar to mutual funds in terms of that they are a basket of securities that trades on an exchange. And they can, of course, contain all types of investments, stocks, commodities, bonds, etc. But the fees are typically much lower with ETFs than they are with mutual funds. So a lot of times when people start learning about the differences between these two, they tend to lean more towards ETFs because the fee structures are much more beneficial for the investor. Finally, diversification. Diversification is the practice of investing in a variety of assets or asset classes in order to reduce your risk and risk exposure. And this is ultimately the main concept of do not put all of your eggs in one basket, right? Sometimes people will confuse the concept of diversification and think that means, oh, okay, just different types of stocks, different sectors, large cap, small cap, stuff like that. And although that is a form of diversification, proper diversification is going to incorporate trading amongst multiple asset classes and actually purposely setting up somewhat inverse relationships sometimes in your portfolio so that if one part of your portfolio takes a hit, another part is growing proportionally. And that's real proper diversification. You are managing to protect your assets regardless of market conditions. We will talk about this more in depth in later lessons as well. But that is it for lesson 2. This is some basic trading terminology that everyone should know. In lesson 3, we're going to talk about risk management, position sizing, and trade management. That's it for today. Thank you, everyone. Mr. Black signing off.